Every morning at 9:30 a.m., market provides the opportunity that if you know how to read, you can become a profitable trader really fast. I use this indicator to scale over $100,000 in less than 6 months, and in this video I will show you exactly how. And to prove that this actually works, I'm going to show you the live trades that I take every single day. So by the end of this video, you will have the complete system on how to find the winning trades in less than 60 minutes after the market opens. So let's get into it. Before I actually get to show you how I piece this model together and what the indicator actually is, I just want to show you the P&L of my last month. So you can exactly see right here, I have made $26.5 thousand. You can see all of my days, all of my weeks, every single profit. You can see this is a screenshot from my broker, and you can see over the period of last 6 months, I have made over $100,000. So if you want to do what I did, just make sure to stick till the end of the video so you can actually do this too on your own. So let's start with the key steps to this strategy. So the first step is going to be to turn on the indicator. So I will show you everything about the indicator later, but for right now it is important that you turn it on, which is of course going to show us some specific levels in the market that on the step number 2 we are going to wait for them to get swept. So the indicator is going to show us some specific liquidity levels. I'm going to talk all about that later, but when it shows us that, all we are going to do is wait for the one side to get swept, and then we are going to target the opposite side. And of course, I'm going to give you exact entry model that when we see, we know that we have to enter the market. There is not going to be any other entry models, but just one that I use every single day, and it's the only way that I ever enter the market. And the third step is going to be, of course, to enter the market. I'm going to show you where to put the stop loss and where to put your take profit. So there's not going to be any guessing. You're going to know everything from A to Z. It's going to be a sweep of one side. So you can see a sweep of one side targeting the opposite side with my entry model, and I'm going to show you where to put your stop loss and where to put your take profit. So nothing is going to be unknown, and by the end of today's video you're going to do this on your own in the live markets. Alright, so the step number 1 is going to be, of course, to come to the session open. Now this is going to work best in the New York session, so it's going to be 9:30 a.m. Eastern time, but of course you can do it too in the London session, but New York session just works overall the best. I'm going to show you the setup for the indicator in the London session and in the New York session, but the whole point of the video is going to be based on the New York session, because that is just at what time I trade, and I personally trade Nasdaq, but you can just trade whatever you want, crypto, indices, forex, everything. You can trade a strategy with it and it will work. So the first thing when we come to the session open is going to be to open the 5-minute time frame. After we open the 5-minute time frame, all we are going to do is wait for the market open, which is going to be 9:30 a.m. Eastern time. And what the indicator is going to do for us, the later I'm going to show you how to find it, how to set it up. It is going to mark out to us 2 key liquidity levels. Now why are liquidity levels important? Because market actually functions on one thing, and that is liquidity. So market, if you ever seen the movement of the market, it was never like this. So it was never a clear staircase to the upside without ever sweeping one of the highs or one of the lows. Market is always going to be kind of radical, and it's going to move whatever it wants, and it is just going to sweep highs and lows always in the market. So it is always going to be completely unpredictable, but one predictable thing that we know is that it's always going to go for the high or the low in the market. It is never going to do a proper market structure like all the other people are teaching you, because the market is actually always going to just sweep highs and lows and seek for liquidity, because liquidity is actually highs and lows. And why is liquidity highs and lows? Because liquidity in simple terms is actually other people's stop losses. So liquidity is equal to orders, and what the orders are, it's just stop losses. So we can assume that people shorted from here to the downside, and we can assume that people longed from here to the upside. So this spot right here is going to be full of other people's stop losses right here, and this place down here is also going to be filled with stop losses. And after the market opens, what the big boys, the institutions, the banks, everybody wants to do is, of course, take them out of the market so they can take their money, extract it from the market, and basically just manipulate the market. Because when they actually sweep one side of the market, they can actually sell the market, because they are going to sweep all of the people's stop losses. So there's going to be loads of people right here willing to sell to them because they are going to be stopped out. And after they do that, when they start controlling the market and pushing it to the downside, what is then going to happen? When they come to this point down here and they sweep actually this point right here, what is then going to happen? There is going to be loads of stop losses right here, and these market makers right here can actually do what? They can get out of their positions, so they can get out of their short position at the lower price. So what does that mean? That they will make money, because right here they entered short positions, and right here they are just going to exit out of those, short positions and actually make money because the market actually went to the downside. Also the other way around, if they trigger the market to the downside and trigger all of the stop losses right here, what do? They buy into the market because there's going to be loads of people selling on this low right here, and when they buy into the market from that point, so a lot of people are going to actually sell to them because their stop losses are going to get hit. When we get to this point up here, what happens then is loads of people right here are going to be willing to sell to them. So they bought for a lower price, pushed the market to the upside, and then they sold for the higher price. So it's really simple logic, and what we are going to do is just follow the market makers. So that's everything. So the next step, of course, the second step still on the 5-minute time frame is going to be wait for the liquidity sweep. So we wait for either a sweep of the upside or the downside. So let's see what actually gets swept first, and you can see right here the top one got swept. So all we have to do right now is just look for the entry confirmation to the downside, because if we do not get the entry confirmation, we are not going to execute the position, and market can do whatever and it will probably just continue going to the upside, because our actual entry model is based on pure logic. And what it is we need to spot the last imbalance in the market. So what an imbalance is, we need to have 3 candles in the market, and we need to just have this hole between wicks of the first and the last, which is the 3rd candle, and that is what's going to be the imbalance. You can see one more imbalance right here. All you have to do is just spot the last one on the 5-minute time frame. And now really the key of this strategy is how do we actually enter the market, and we enter it when this fair value gap actually gets disrespected. Now how does it actually get disrespected? All we want to see is a closure below this fair value gap. So once we actually close, so we want to see a candle closure right below this fair value gap, and that is exactly when we know that this fair value gap right here got disrespected, because if we just wicked inside of the fair value gap but continued going to the upside, we wouldn't have made an entry because we didn't disrespect it. But when we closed below this fair value gap, what we do is we actually enter the market targeting the opposite side, and what happens is market is of course just going to go for that liquidity for those stop losses on that low down there. So this is a really simple model that is actually proven to work in the live markets. And also one more thing that you have to understand is that complicated is not profitable. So your charts should not look like this, filled with a bunch of indicators, because in the end market is actually something very simple. It is always going to go for liquidity points and sweep liquidity in the market. So you don't want to trade something complicated, because it is going to be hard to execute and it's going to be easy to make mistakes, and in the end it's probably not going to even work. And now to the final and the most important thing, what is even the indicator that we are going to be trading? And the indicator, the name is going to be ICT kill zones plus pivots, and it's going to be from this creator right here, trade for op. And the point behind this indicator is that it's going to mark out session highs and lows. So if you want to trade the New York session, a session that happened before New York is London session. So we want to place this indicator to mark out only London session, because that is the key levels that we are interested in, because at those hours there was the most liquidity, and when it closes, when the session actually finishes, when we come to the New York session, all we have to do is for that liquidity to be claimed by the market makers, and we are just going to follow them. And now I told you that I'm going to tell you what if you want to trade a London session. Well, you are just going to seek for the sweeps of the session before that, and that was the Asia session. So if you want to trade in the London session, all you do is you have to check this box right here and not check the London box. And if you want to trade same as me, the one that actually works the best, it's the New York session, and you just have to check the London box, and that is literally it. So now I can actually go to the live charts and actually show you how this actually looks in the real markets. Alright, so this is the first trade that I'm gonna show you in the live market. So you can see first of all that we have our tool right here, ICT kill zones and pivots. So all you need to do is turn it on, and it should actually look something like this. So it should be a red box for the London session, and it should mark out low and it should mark out high. The second thing is we want to be on the 5-minute time frame. We are, and all we do right now is we just wait for the sweep of the one side. So it's pretty simple. So all you need to do is just wait, and when it actually gets swept, so right here we actually had the sweep. So right now what we do is we just zoom into there and we wait for the entry confirmation. So right now we know that all the people that shorted from here like this with a bunch of orders, what happened? They actually got stopped out by this wick right here, because you can see we went above, so everybody got actually stopped out. So the point is that right now we are ready to actually short the market, because a bunch of people were actually, you know, stopped out right here. So also what other thing we can expect is really fast momentum towards our take profit. Because why? Market is just going to want to go as fast as possible from here all the way to the bottom to actually get the most amount of money as fast as possible. So the first thing that we want to check out for the entry model after the sweep is the last fair value gap. So right now you can see that we have a fair value gap right here. So you can see this is a week high, and then this is a week low right here, and this is our fair value gap. So you can see, if I zoom it in a little bit better, you can see the first week's high and the third week low are just not crossing over each other, because if it was like this, then this fair value gap wouldn't even exist and it wouldn't be a fair value gap. So all we do right now is we just wait for the market in this respect of this fair value gap. So if I fast forward the market, let's see what happened, and there it is. So we just closed below this fair value gap. So all I do is I enter the market right here, and where do we put our stop loss? So we always want to put our stop loss somewhere above this fair value gap, but the most beautiful way to put it is actually on the top of the candle that actually, you know, inversed it. If it was only one candle, if it was the few candles like this next to each other, so if we had few more like this and then we got the inversion, you know, after few candles, you want to put it at least above the fair value gap. So when we successfully entered the market like this, what we want to target actually is, you know, the low below. So if we target this low that the indicator actually marked out to us, let's see how the market is actually going to play out, and you can just see a straight momentum towards the take profit. So this trade maybe lasted like 30 minutes and we actually made 3.56 risk to reward. And what that means is, if we risked 1% on a funded account, let's say 100,000 funded account, that would be a $1,000 risk, and we would actually make $3.56,000 in this single trade. And it was just only few simple steps. So that's what I'm talking about, why this strategy is so good. And it is also a very high win rate. So you saw on the beginning my results, it is over 80% win rate. So right now let's actually head to the second example. Alright, so we are at the second example on the live chart. So the first thing that we always make sure, indicator is there. You can see the red box that is, you know, marking out the key levels. We are on the 5-minute time frame. So all we do right now is we just wait for the sweep of one side, so either to the upside or towards the downside, and then we just look for the reversal, and that is it. So let's actually wait to see which side is going to get swept first. So if I fast forward the market, let's see if the upside is actually going to get swept. So it looks like it, so let's just see, and there it is. So we actually swept the upside. So right now, when we have successfully swept the upside, all we want to do is an entry model towards the downside. So really simple. Now what do we exactly do after we get sweep? We just want to see what is the last fair value gap the market created while going towards this liquidity point. So as you can see, we don't have any fair value gaps right here, but the first fair value gap is right here. So all we want to do is we want to mark out this fair value gap, so you can see week's high to the third week's low, and that is the bullish fair value gap. So fair value gap while market was expanding to the upside. So we want to mark it out, and as I told you, we want to wait for the actual closure below the fair value gap, so a disrespect, and you can see market even pushed a bit more to the upside. But the point is, market actually did not make a new fair value gap. If the market right now, after one more sweep of this high, made a new fair value gap right here, we would already enter the market and we would already inverse it. We would already disrespect it and we would be in shorts. But since market actually did not make a new fair value gap, we are still waiting for this fair value gap to actually get disrespected. So right now we just tapped into the fair value gap and there it is. So all you need to do right now is enter the market, because we actually got the disrespect of the fair value gap, and we want to put a stop loss, of course, above the actual fair value gap on the body or on the wick. It's not really that important, but as long as it is above the fair value gap and you give it some kind of space if it wants to make some kind of pullback. All we do right now is we just target the low that is actually marked out by the indicator, and that's it. So right now we just wait and let's see what is actually market going to do. So looks like it's going towards the take profit and it's about to hit, and there it is. So you can see just a huge dump towards the downside after we actually entered the market. So that is the second example for 3 risk to reward, so $3,000 on a $100,000 funded account. Alright, so just before you actually exit the video, I have a gift for you. So something that I would give you for completely free since you actually made it to the end of the video. But just before I do that, if you liked it, if you learned something new, make sure to leave a like, subscribe to the video. That just makes me know that I'm doing actually something right. So the free thing that you can actually claim down there is going to be my 10-page free PDF about how to even get this strategy nailed down more and just better overall. So some kind of tricks that you can use to your advantage to even have a higher win rate and to just have it by your side when you are actually trading it in the live markets. Also, one more thing, if you are maybe interested in working with me one-on-one, make sure to go down there, check out the link in the description, because there may still be some spots available. I'm not sure, but make sure to do it fast, because if they are still available, it will not be for long for sure. So I hope you like the video, and I'm just going to see you in the next one. Peace.